All right, traders, I am back again with another video. Want to wish you all a happy new year. First video of the new year. Going to try to be busy this year. So I'm starting off today, the second day of the year, to get busy with you guys. And the thing I want to talk about today is trading Ichimoku with smart money concepts. So I'm going to show you some smart money concepts that you can use for your Ichimoku trading. And also, it doesn't have to be with Ichimoku. It can be just with nothing on your chart and just learning to trade these smart money concepts that I'm going to show you. So we'll be talking about one concept today, and I'm going to show you how to incorporate that in your trading plan. Also, I'm going to talk to you today about how you can become a professional funded trader and how I can help you to do that. All right, so stay tuned. Watch this whole video. You're going to learn a lot, and I'm going to try to help you as best as I can. So let's get right to it. All right, guys, before I get started, just want to make sure you understand and know one thing. I am not a financial advisor. I am just showing these videos and showing and talking about the things that I talk about for educational purposes only. So anything that I do and show you today is based off of showing you for educational purposes only. I am not giving you any trading advice. If you want any trading advice or you decide to take upon anything that I do show you today, please do consult with your own financial advisor so they can help you to understand and consider the relevant risk factors associated with trading Forex, futures, stocks, or any other asset, okay? So guys, do you want to become a professional trader? Have you ever thought about that? If you want to become a professional trader, I believe I can help you to do that, help you to achieve that goal. So one way that you can achieve that goal is become a funded trader, where you would trade an account. You have a practice account where you have to try. Well, actually, it's an account where you have to reach a certain quota. Okay, so maybe on that account you have to reach $1,500 or $3,000, and once you do that, you become a funded trader. Well, one of the best ones that I'm going to tell you about is Apex Trader Funding. Right now, Apex Trader Funding is offering a 90% off right now to join and become a funded trader. Now, what happens first? You have to pass that eval, and that's the main thing. So here's how I'm going to help you. If you look down below this video here into the description section, and below there you will see I put a link for Apex Trader Funding, and that's the link that I want you to click on. You click that link and become join Apex Trader Funding. You can open up one of the following accounts, okay? So you could see here's the account sizes. And right now, like I said, there's a 90% off. So basically you won't be paying what you see here, but this is what you'll start off with. So basically, if you got a 25K full account, you would have to reach $1,500 to get funded. Once you get funded, you get 90%. That first $10,000, you get 100% of that. That's your money, $10,000. But then after that, once that 10,000 is hit, and then you move forward, you split this 90-10 with them. So you get 90% of the profit and they get 10, and that's as long as you stay with this program. So I'm telling you how I can help you. So here's how I could help you. All right, so first of all, go down below, click the link where it says Apex Trader Funding. That's my link, and from that point, I'm going to be able to help you because first of all, you go to my site. After you join up, go to my site, www.fxatOneglance.com. When you go to my site, go to the blog here, all right? And then keep looking for when I'm going to trade live. So what's going to happen is once you join, I'm going to trade. You'll see me trading live. I'll let you know a day ahead of time what days I'll be trading live. And you just join that session, and then I'm going to help you to learn that. And also what I'm going to give you is some tools that are going to help you. So I'm going to give you some trading I'm going to give you some trading strategies. I'm also going to give you some strategies that you can just basically really, it's going to tell you when to get into the trade. All right. So I'm going to give you certain types of strategies that are going to help you to get into the trades. It's going to be based off of momentum. And if you follow the strategy, you'll be able to profit more than likely. Okay. All right. Because I'm not going to guarantee anything, because I can't guarantee anything. Somebody may do some crazy things and not do the things that are shown. But if you want to become funded, I'm going to give you the tools. I'm going to give you the trading tools that you're going to need. So I'll give you the indicators that you need. I'll tell you which indicators to use. And guys, the best thing of all is you can use TradingView. So all these indicators you'll be able to get off TradingView, and I'm going to show you which ones to use. I have some that are specifically designed that I have used for TradingView that I had developed for myself. So I want to be able to incorporate those and help you to take those trading tools and use them. So again, join that Apex Trader Funding. Hit that link below where it says Apex Trader Funding for Chaos Trader 63, whatever it is down there, and then you can become a funded trader. And once you do that, I will help you to qualify. And once you qualify, we'll also have trading sessions throughout the week. And once you even qualify, you can still rely on me to help you to stay qualified and keep gaining that money each and every week. And then the second thing you could do, which is not free this time. The other things was free. Basically, you do have to pay for your account. So the account size that you purchase. So if we go back up here, you can see you do have to pay that monthly fee. But again, like I told you, it's going to be 90% off. And then therefore, you won't have to pay what you see here. But once a month, you'll have to pay that. And then you'll keep, if you're making money, that fee shouldn't hurt you. All right. So that's something free. It's not anything that I'm trying to get from you. But then the second thing that you could also do is, again, go to my site, and then you could join my community and become a member of my website, a lifetime member. At this point, I'm offering a lifetime membership for $250 flat fee. So if you pay that $250, you become a FX at One Glance lifetime member. You'll become a lifetime member. Every single thing that I learn and know, I'll be helping you to learn and understand anything about Ichimoku, any kind of strategies that I know, any kind of tools that I use. And every weekly webinar you can attend, and you can watch the recordings. All right. So that's something that you will be able to do for the rest of your life, just for a $250 fee. All right. And trust me, you can ask the traders that already are members if it's worth it. I guarantee you it's well worth more than $250. But I'm not out to get your money. I'm out to help you to learn. Okay. So let's get started with this thing here. Before I get really into everything deep, I really want to talk about one thing. I always like to give you a word from the Lord. And what I want to tell you today, do not live by human desires, but by the will of God. All right. Therefore, since Christ suffered in his body, arm yourselves also with the same attitude, because whoever suffers in the body is done with sin. As a result, they do not live the rest of their earthly lives for evil human desire, but rather for the will of God. For you have spent enough time in the past doing what pagans choose to do, living in debauchery, lust, drunkenness, orgies, carousing, and detestable idolatry. They are surprised that you do not join them in their reckless, wild living, and they heap abuse on you. But they will have to give account to him who is ready to judge the living and the dead. All right. So God bless. Let's get started with this. So there are those who think they are studying the market. What they are doing is studying what someone else has said about the market, not what the market has said about itself. So guys, what that really is talking about, and this is a quote from Richard Wyckoff, one of the most famous traders of all time. But what I wanted to say to you guys is this. The main thing that I'm trying to let you understand is that what he is telling you is that what you do is go looking on YouTube and looking for courses and looking for this and that, studying and learning what somebody else is telling you about the market instead of diving yourself into the market and understanding the market yourself. Those are the things that you need to do yourself. You need to be able to understand the market, study the market, and know the market yourself. And yes, if some things that you may learn from someone else that you may be able to incorporate into what you know already, that's what helps you. But when you don't know those things and you just go by what someone else is telling you, how do you know if it's true or not? You have to study it. You have to learn it and make sure it's good for you. You have to test it. All right. So it has to be tested. When you buy a car, you go test drive it. You want to see if it's good. All right, same thing with a strategy, or same thing with anything that's taught to you. You want to test it and make sure it's good. But see, guys, what we have here is mostly people that don't understand what the smart money concept is. So basically, this smart money concept is just a new name for old concepts. All right. So if you really understand the market, you'll understand that some of these things that people are teaching you, you'll hear traders talking about like liquidity grabs, multiple highs or lows. It's just the same old Wyckoff concepts basically for up thrusts and springs. So people are talking about, you'll hear other traders, another trader, ICT, and some other traders that I hear talking about breaker blocks. They are the exact same thing as fractal bounces. All right, something that Bill Williams used to talk about, fractals and fractal breaks and fractal bounces. But now you're hearing people say they're breaker blocks and this and that. So you get caught up understanding and hoping that you're learning something that's nobody else knows because it's a smart money concept. This is old concepts, guys. Old concepts, new names. All right, so don't fall for the things that people tell you. Learn it yourself, understand it, see if it's right, see if it's good, and don't just fall for any old thing that people tell you, right? Because again, there's not much that hasn't been known or said about the market. So again, new name, old concepts. So the market is made by the mind of man, and all the fluctuations of the market and all the various stocks should be studied as if they were the result of one man's operations. Let us call him the composite operator, who in theory sits behind the scenes and plays a stock to his advantage. Again, another statement by Richard D. Wyckoff. What Richard is talking about right here is the composite operator. Who is the composite operator? That is the smart money traders. All right. That is basically the institutional traders that we talk about today. Even back then, Richard Wyckoff understood and knew that there was somebody else that was who controlled this market, and he wanted to be on the same side as them and understand what they see and what they do and how to see them and spot them by looking at the market. And those are the things that he learned and understood. And those, again, are smart money concepts that Richard Wyckoff taught long time ago, that we try to change names and this and that. They're the same old concepts. All right. Just different names that people come up with. So guys, you look at this chart. You ever see this chart, like you're trying to enter a trade here and you wonder why the market drops down to this level or something? That's something we want to understand. Why does the market drop down to these levels when I try to get into a trade? All right. Why does the market have these gaps here? All right. So what you see here is a gap, which is an imbalance. Okay. And then this gap is based off of 3 candles. So how do we find this gap? We find this gap with 3 candles, and we understand the relationship between the wicks of those 3 candles. Do they overlap? If these candle wicks do not overlap, then there's an imbalance there. All right. And a lot of people call these fair value gaps. You'll hear them called as fair value gaps, FVGs. It's just basically an imbalance in the market. On this chart, there's many imbalances on this chart. All right. So you'll see, like, from this point to this point, there's a big imbalance in here. Then the market comes up and fills that imbalance right here. All right, came up to this level, filled some of this imbalance, and then drops back to the downside. But within here, there's more imbalances. So let me show this to you really quickly. So with my tool, I'll be able to show you, basically, you could see this area here and this wick here. There was a gap here because between the 3 candles, 1, 2, 3, all right, the wick of the first candle and third candle, let me clear that off for you. The wick of the first candle and the third candle basically didn't overlap. This is the first candle. This is the third candle. So 1, 2, 3. Look where this wick is. Look where this wick is. So when I look at other areas on the chart, like if I look at this area, there's 3 candles here. So any 3 candles you can take. This wick of the first candle and the third candle overlap. There's no gap. All right. So then if I look at, let's look at these 3 candles here. These candles don't gap. They overlap. These candles don't gap. They overlap. But once the market starts really moving, then you start to see that gap. So here's where the market started to move a little bit. And then you had this third candle first candle and third candle left a tiny, tiny gap, not much. All right, but it wasn't a lot of a gap. So, but it's still, that's what you're going to be seeing when you're looking for this imbalances that I'm showing you. All right, so let's move on. Let's look at this charts. So the way we find those imbalances is we look at any three candles. All right, so it's going to be the first candle and the third candle, between the first and third candle. Look at the wick of the first candle and the third candle. Do they touch each other? If they don't, do they touch or overlap? If they don't, that's an imbalance there. There's a gap there. That's where the market really started to move. You had some movement and there was an imbalance in the price. All right. So any three candles, we can look at that. Any three candles you pick, you can find if there's an imbalance. So here's another imbalance. So this would be a bullish imbalance. And here's a bearish imbalance. As you can see, three candles, the first wick and the third wick don't overlap. This wick here should have had a wick that came up above this wick, or at least to that wick. Since it didn't, it left this whole area as an imbalance. And this is a very important area because this is where the market's going to come back and try to fill that imbalance. All right. So when we look at our chart here, there's an imbalance here. All right. You could see 1, 2, 3 candles, but this first candle and third candle don't overlap and it leaves a big gap. And that's an imbalance. So what do? We stretch that zone out across our chart, and then we wait. We wait to see if the market's going to come back to it. So when we look at Ichimoku now, we're looking at Ichimoku. We want to see, basically, we have a bullish crossover, TK crossover. The price is above the cloud, so that's all bullish. And then our cloud future is bright, so that's bullish. And then Chiku span is above price, so that's bullish. So everything on this chart is bullish. So we should be looking for a move to the upside, right? That's basically what we would be looking for, a move to the upside. So we're going to watch to see what this chart does. The market comes back to this level, as you could see. Now the problem here is it came back and hit right on the level. It didn't fill this whole gap up. All right, because we expect the market to come down and fill this whole gap. But at this point, it didn't fill that gap, and then the market took off. All right, so you're trading Ichimoku. You could see everything was bullish. So when you see this gap, so when you're trading Ichimoku and you see this gap, this imbalance, and you stretch that across your chart and you wait for the market to come back to it, since all concepts with Ichimoku are bullish, we are going to look for the market to move higher. Therefore, the market moves higher right off of the bounce of that imbalance. So here's another imbalance. But when we look at our chart, thinking about Ichimoku, we could see Ichimoku concepts. We had a TK crossover that was bearish. We had a future that's dark. So we had gray skies, which was bearish because we had a Kumo twist that was bearish. We had price below the cloud here. So that is bearish. We expect the market to go down. And Chiku span is below price. So we know that 24 periods ago, 26 periods ago, we were back here and the market dropped. So we know that the market's moving to the downside. So now what we're going to look for is, since we're talking about that imbalance, that gap, what we want to see is the market come back to this level. So what do? We extend that zone. So when you extend the zone, we could see the market pulled back up into the zone, and this time it filled the whole zone. All right. And then the market drops. And you had a big trade off of that because you pulled back to that imbalance. Now, again, there's other imbalances on this chart. This was one of the bigger ones, but there's other imbalances between this point because there was an imbalance here. Right. But it came back to fill this one. So eventually we would believe that the market would come back sometime in the future and fill this gap. Now, it doesn't mean it's going to drop to the downside. It could fill this gap and then continue going. So it could come up after this, move up, come into this zone, fill the gap, and then move higher. All right. So it doesn't mean it has to be a move to the downside just because we're below the cloud or anything. You always want to watch and see and look for price action, most of all, to get into a trade. All right. But again, I have tools that I can help you to get into trades like this when you see the change color of candles, you're going to be able to enter the market. Also have signals that'll tell you when to enter the market off of these levels. So that's why I told you you should join that Apex Trader funding, and I can help you to be able to get funded. All right, so let's look at what else we got going on here. So here's another zone. All right, you can see this zone 1, 2, 3, and you can see Ichimoku concepts. Everything is bullish. All right, we broke above the cloud. We had a Kumo breakout here. Future is bright. Blue skies ahead of us. Chiku spans above the price, but it's also above the cloud, and price is above the cloud. This is clear selling ahead of us. There's nothing here to stop us. All right, but we get this imbalance here because the market started to take off at this point. Now there's other imbalances here, and I'm going to draw them out real quick. I drew the most recent imbalance. There's an imbalance here. There's an imbalance here. There's an imbalance here. There's an imbalance, a slight tiny imbalance here. I wouldn't probably even mark that one. But those are the imbalances right there. And the market, eventually, we would believe the market will come back and fill those imbalances, all right? So those are what we see on the chart. But I filled the biggest imbalance. I didn't fill it. I actually drew it out. That's the one that I'm looking at, this bigger imbalance. And that's the one we're going to be concerned with. So we extended across our chart. And when we look, the market pulls back to this level. Again, how would you get into a trade? There's a couple ways to get into a trade. One of the easiest ways that I'm going to tell you is this. First of all, there's nothing that's going to beat price action. That's going to be number one. Price action, enter into this trade here. You have basically a bullish engulfing right here. You could enter this market right there. Also, you can enter the market when it closes above Tinkinson. That's going to be one of your most reliable trades. And then again, if you follow with me, I'm going to give you a couple tools that are they're going to be red on the downside and they're going to be green on the upside. You're going to enter on that green candle and watch that market go. All right, and I'll explain the concepts to you and everything. And you can see what happened here. The market took off. Basically, price action will get you into this market quicker and better than anything that I could tell you. All right, and a lot of times you play the zone. All right, so you can walk this zone, and I'll teach you about walking the zone. Basically, walking the zone is when the market comes into this zone here. So the market drops down and comes to this level. At this point, we really want to be ready to get into the trade, but the market drops midway down to the level. So for me, I'm going to put my entry right at the top already, and I want the market to come up to me. So if this market drops lower and goes down to the bottom, then I'm going to move my entry down to the midpoint, and then I'm going to let the market come up to me. All right, and that eliminates a little bit more risk. All right, so I have a smaller stop loss. I'm only playing that zone, and then you can see where the market goes. So that's a little concept about walking the zone. I'll explain it a little more if you either decide to become a member or join one of my live trading sessions. Okay? So again, we're looking at another opportunity here because we have an imbalance here, and you can see that imbalance based off of these three candles. And there's the top of this first candle and the bottom of this third candle. Leaves this imbalance right here, this little imbalance here. So we extended this across our chart, and we look for the market to come, pull back to that level, and then we look for the market to go. That's what we would be looking for the market to do. All right. And let's see what the market does. Let's see exactly what this market does. The market does pull down to this level. Now, let's back it up a minute. The market went up a couple candles, dropped back to the zone. Again, remember I told you about walking the zone. So now the market pulled all the way to the bottom of this zone. You can put your entry, guys, at the lower level. I mean, the upper level or the midpoint now, because if we're down here, you can put your entry at the midpoint now. Move your entry from up here down to this midpoint level and let the market take you in. All right, but a lot of times people, again, what's going to hurt you is you don't understand where to take profit. All right, so I'm going to talk about where to take profit right now. So one of the best ways to take profit is to understand the one-to-one concept. All right, so basically that one-to-one concept is where we're looking at a measured move. And that measured move means A, B, and you'll have a C and a D leg. So you have an N wave, as we learn in Ichimoku. And that's not just Ichimoku, that's the market, period. The market moves in these N waves. Some way or another, it's basically an N wave, P wave, or a Y wave. Mostly it's going to be these N waves when the market's moving. A lot of times when you get into a range or something, you may see a P wave or a Y wave. All right, and then again, there's an S wave, but it's just still part of an N wave almost. All right, so those are the waves that you would see when you're watching the market. All right, and then the thing that you're going to really want to understand is where to take profit. So the 1-to-1 target means C and D. To get to D is going to be the same length as this move here. So let's say we're talking about Forex, and we're saying this move right here is 100 pips from A to B. What we're going to say is C to D is going to also be 100 pips. So this would be the 100 pip target from this level. Again, you could say, what if this was 75 pips? Then we would say this is going to be 75 pip move here. All right, if this was 10 pips, then we're going to say this would be 10 pip move here. It wouldn't be 10, but just get the point. You understand what I'm trying to say? All right, it's a measured move. It's equal moves, equal legs. All right, your AB leg and CD leg are equal. So I say AB equals sign CD. That's your 1-to-1 measured move. And let's see if the market gets to that 1-to-1 measured move level. There's my 1-to-1 measured move right there at this 1, all right, which is going to be 0.89880. That's the 0.618 level, the 1 level, the 0.26 level. At this point, we didn't make it to this level. Why did we not make it? We just missed that level. And you're not always going to make that level, but that's a level that you want to shoot for and then watch the market from there. But the reason we didn't hit that level was because a couple things. First of all, as a lot of traders will try to tell you about liquidity. All right. There's liquidity in this area right here. Because see these wicks are basically going to be liquidity. The market flattened out here. All right, so you have this sell side liquidity here. These wicks would be sell side liquidity, sell side liquidity, sell side liquidity, and sell side liquidity here. So that's what you would be looking at. And basically the market pulled up to this level, grabbed this liquidity, and then looking for the market to drop back down. That's why the market didn't reach this level. We don't know how far down we're going to drop because, again, this is liquidity in this area. All right. So the market drops down to this level. This would be a lot of times. Okay, so I'm going to talk about this real quick. And I don't want to get stuck on this and get too long. But anyway, this level here for me, I always look for the market to pull back to these fractal levels. This is what I call a fractal bounce. All right. But this is what is also known as a breaker block that you'll hear people talk about. We've been talking about fractal bounce for a long time ago. All right, but you'll hear people talking about another smart money concept that they claim is a breaker block, and that's this right here. The same thing as this fractal bounce. This is a fractal level right here. This right here is a fractal level. And the market comes back to this zone that I draw with the wicks, and then the market pulls higher. But the market didn't reach our 1-to-1 level quite because we have these liquidity levels, where the market came up to grab that liquidity and drop back to the downside. That's the reason that we didn't hit that. That's more than likely the reason that we didn't hit this level 1-to-1 right here, because that would have took us basically in the middle here. All right, and then you'll see this level is also going to be a level of liquidity. All right, buy side liquidity levels. So let's move on. Let's continue. Now, here's a chart that I want to really show you something. This is a really nice, and I don't have any Ichimoku on my chart, but you could see here, this was candle. So we're going with candle 1, candle 2, and candle 3. With candle 1, 2, and 3 there was a big gap right here. This gap here started there and was right here. All right, so this was the gap. Why do I have that small gap right there? That small yellow line? Well, what happened was the market pushed up and then came back and filled most of this gap. This gap was this size at first, but it came back and filled that. So now I only make the zone this big because we still had that gap. I eliminated what it filled. And what the market did is come back to that gap. How come it came right down to the bottom of that gap and then took off, guys? Right to the bottom of that gap and took off. Now within this area, you can find more gaps where you're going to look for the market to pull back to and find trades. But again, those are going to be the levels that you're going to look at trading. And again, we don't have Ichimoku on the chart now. We're just looking plain and straight at trading the market like it is. All right. Let's look at our next thing. So again, I like to trade the market with the volume profile, and I like to use the volume profile levels. And you could see here what gaps are really. You could see the imbalances shown on this chart here. These imbalances are shown from this trading zone here. All right, so you have your value area high, value area low, and then inside your value area. All right, this is where most of your trading takes. This is where 68% of the trading takes place. All right, but where you see these little areas where, so there was more trading in these areas where it's extended farther, but there was less here. So there's an imbalance here. These are showing imbalances. All right, and you could see what the market reacts like at these levels. Well, looking at these imbalances, you could see there was actually a real true imbalance just by looking at the chart and not looking at this. If you go from this wick to this wick, there was this imbalance here. But it got filled and it came all the way back down to this wick right here, the market did. And then pushed up. All right, so this is trading with nothing on our chart. And again, it made that measured move. So you would say that measured move started basically here, made that N wave and pushed higher. Okay, so it made an N wave again. That's how the market moves, mostly in N waves. You're going to see that. And when we get flat, you'll see other types of movements. All right. So you could see these zones are seen by the profile, the market profile, the volume profile. And you can draw these gaps in. Where these gaps are is where the lower, smaller areas that are not filled like these bigger areas here. This area is a little smaller. So that's a little imbalance. A little imbalance here. A little imbalance here. And those are the areas. Even like if you look here, like I would look at these little areas, but I want to see better areas than that. I want to see bigger gaps and zones. And those would be the areas where I look for the market to come back to and bounce off of. So each zone I drew based off of just looking at these gaps here, and look how the market react at each level. So the first time it kind of came up to this level, kind of blew through that level, but then came back down to that level. And then this level here, it broke through, but then it came back down to that level. This is just by using the volume profile. This was not by adding the gaps that I see on the chart. Now, when I look at the chart, these gaps pretty much line up. See? See these gaps lining up pretty much? Candle 1, candle 2, candle 3 made that gap. Now, when I look at this one here, really didn't see this gap. So there was nothing here because this all looked like it overlapped, but by the profile I see a little imbalance. Then there's another imbalance here that I just showed you. It was starting here and here. So just looking at without the volume profile and just looking at these candles as we stated and shown, you can definitely see these imbalances and look at these imbalances to get filled and trade. Okay, even without the volume profile, but you can see how accurate these gaps are by these imbalances are by just looking at the chart. All right, so that's a big thing. All right, let's move on. So what I like to do when I'm trading is I like to use volume. I'm getting deep, but I want to use volume spread analysis to determine if I might be able to trade the level. So what happens is volume precedes price, and this means that volume comes before price. The volume kind of lets you know and tells you two things. It tells you the things that the institutional traders are doing. All right, because the institutional trader cannot hide two things from you. They cannot hide price and volume from us. They are not able to hide price and volume from us. And if you understand and know how to interpret those things, you'll be all right. So let's look at this real quick. So when the market's moving to the downside, would you want to see increasing volume or decreasing volume? So this move here down, would you want to see increasing volume or decreasing volume? You really want to see increasing volume because you know that the institutional traders are with that, and that volume is pushing this move. So when you see the market move to the upside, do you want to see increasing volume or decreasing volume? Again, you want to see increasing volume as the market moves higher because you know that institutional traders are with that move also. If you don't see that and you see opposite, then it's not smart money following that move. All right. Now, so when we see this right here, the market was moving higher. This was moving down. You could see the drop here, right here. That means institutional traders were not with this push to the upside. All right. So I look at each candle and you could see, if you use volume spread analysis, you could see this candle here, this candle here, and this candle here. The volume all started dropping off right here. And the market flattened out a little bit. Then the market pushed higher. But look what happened here. On this big candle, we have what we call effort and result. This is your effort, how much volume you're getting out, and this is the result. The result is going to be your spread. All right, the spread is the spread of the candle, the high to the low. If you get big effort, you should get a big result, right? You should get a big result. But you didn't get a big result. Your result was not that big, and also it closed in the mid of the spread. On this big candle, I would have expected a bigger result. So this means, again, smart money is not with this move that's going to the upside. And then the next candle has pretty much the same spread, but look where it closes. It closes in its lower third on volume that was a little bit less. But then we get another candle where the volume was about the same size, and it's pretty even, pretty good, not too bad. But the effort, again, is not what we would expect. The result is not what we expect with this effort. And then you can see the volume dropping off. So I know that at this level, we're getting weakness, and I'm going to look for price action to trade this. Now, here's where you get fooled. You always have to wait to see and make sure. Now, I trade the level, so I really don't need to wait and make sure. And again, trading the level, I might have got stopped out, but I'm still coming back to this trade. What happens here is we could see, looks like the market's starting to move to the downside now. We're losing right here. The volume's dropping off. And then we get all of a sudden this big spike here. This is just fooling these traders. This is a bull trap. It's just trapping traders to believe that we're breaking out of this level. All right, grabbing liquidity off of this upper level because you have a double high here, multiple tops right here. So grabbing this liquidity and then looking for you to move down. You shouldn't have got too excited here. You should have waited, been patient to see what really is happening with the market. All right, because don't get fooled on these big candle moves. Because when I see a big candle move, I'm usually not getting into it because there's a lot of things behind big candles. That's where directional change takes place a lot of times. All right, on big candle moves. These institutional traders have to sell to buy and buy to sell. That's how they trap you. But you can see what happened the very next candle. These traders right here that went long here are trapped, and they're helping to move this market even lower now because they got to get out of their trade or they're stuck. They're in trouble. You can see again how the market came back to that level. And again, you could see on the volume, we got a big volume. We got a big volume spike right here. Right here, inside bar. Bigger volume than the previous bull volume that trapped traders. And again, if this was such a strong candle, why did it close near the midsection? That's because all of this volume wasn't bull volume. All right, it was a lot of bear volume too, and that was trapping traders. They got trapped already, and now the market moves to the downside. So as I watch this, the way that I know that the market is, that the institutional traders are with this move, is that now I could see increasing volume. So I know they're with this move. All right, all through here. And then I see it flatten out. So what I see now is some buyers come in, then we have a big candle here. Big red candle, but we don't get the result we want. We have a big effort, but no bear result. So the effort and result don't match with this little candle. I should have had a big drop right here. That lets me know there's an issue here. Then the very next candle is bigger than the previous candle. And you see the bull candle coming in, and you can see the spread of this candle bigger than the spread of the previous candle. And then the market starts to move to the upside. That's how I know to get out of my trade. Again, along with my 1-to-1 measured move. All right. But again, looking at the volume. Okay. So I don't want to be too long here, but just really a lot of information I want to try to get into you. All right. So I don't like to show you guys things that I don't do. But first of all, let me show you again on trading. I use Quant Tower to trade the markets. I like the platform a lot. And you can see there was an imbalance here. And you can see what happened with the market. The market moves up, drops back down to this imbalance, filled most of it, then filled the rest of it and moved higher. Bounced off of that level, moved higher. Now the market flies through that imbalance, and where does it go? To this next imbalance that was already drawn on my chart. Wasn't that already drawn on my chart? A long time before the market ever came there. And you can see where the market came down to. All right. So where do we expect the market to go to now? We expect it to fill this imbalance and go down to this imbalance. So the market fills this imbalance as we thought. As you can see, we just bounced on it. And if you took the trade long, you might get in trouble here because the market came back down to fill this whole thing. All right, so you can see the imbalances that I have, and then that fractal. You can see where the imbalances are. All right. Now, I don't like to show you anything that I don't do. So what I'm going to show you is a trade that I took. All right, so one of the trades that I took off of this was right here. I took a trade from this imbalance and traded it down to this imbalance. Now, I kind of suspected the market to go down to this level, but instead I got out here because at the time had a pretty good trade, saw a little bit of pullback, and so I got out of the market. The market came down to the level I expected it to, but again, I expected that it should come back down to this level, and again it did. So this isn't anything that I show you that I don't do. You can see the trades I made. The reason I got into the trade this first time here and then I got out here was because we had a nice entry here, and I think I could show you. I got into the market the first time, then I got out. Let me show you where I got out. I got out here because I took a trade off of this upper level here. All right, I had a bounce off of this upper level. So the market dropped, but it went through the imbalance a little bit, but then it closed up here. So I got out of the trade and I didn't make much profit, but then I got back into the trade on this. See this rejection right here? This nice rejection of the upper level again. The market steadily was rejecting this upper level that I have drawn on the chart right here. You could see all the rejections into that level. Came back rejecting that level a bunch of times. Then it rejected it here. So I got into the market definitely right here. Look at this candle right here. We clear that up so you could see it. Look at that big rejection off of this level, and then it closed down here. I got into the market right there, traded it down to this level. So again, I don't trade and do anything that I don't tell you guys. As you can see again, let me show you that trade one more time. You can see that trade, and there's that rejection, that big rejection. I got into the market there, filled that imbalance, and dropped down to the next imbalance. That was my trade. All right. So I do the things that I show you. Don't just make these things up and then don't expect you to expect you guys to do it, but I don't do it. And then again, I could look for my measured move. So my measured move expected the market to come down to this level. I don't believe we made it down to that level. Let's see here. We didn't quite reach that level. And again, we probably didn't reach that level because there's liquidity here, right here in this area. You could see it here. But there also is liquidity down here. And that's where we would expect the market to come down to, this area here. But it also was grabbing this upper level liquidity. All right. So I don't show you guys anything that I don't do. I don't make stuff up and then don't trade it and expect you guys to do it. But again, when we look at the charts, look where this lower imbalance was. Okay. Look where the market came down to. Look at this lower imbalance. Look at this market coming through all these imbalances, touching all these imbalances, filling all these imbalances. All right. So now you know where you can trade these levels. All right. So for me, like if we're trading with Ichimoku, if I had nothing on my chart, I'm just taking these bounces off of these levels. If I'm trading the direction of the market, then I'm trading the bounce up into that level and then back down. So I know that when I get into the trade up here, I can trade it down to one of these levels, all right, along with my 1-to-1 measured move. So that's what you see with that chart. Here again, we can see an imbalance. And then look at this monster candle. I told you guys that I wanted to show you that this imbalance was filled even with the news event, all right? This big candle was news. And again, this imbalance was here, right here. The news dropped right down to the imbalance. I wanted to show you this just because I wanted you to understand that even the market came right down to fill that imbalance, even during a strong news event. All right, and again, you can see these imbalances, the market moving from these imbalances back down to this level and moving higher. Had an imbalance right here. Market came all the way back down, not using anything on my chart, just using the imbalances, the trade, and looking at the market moving off of these levels. So these imbalances are going to be good for you to look at. All right. And again, another imbalance. You can see how the market came back to this imbalance and then moved higher. It didn't fill this whole imbalance, so we probably expect the market to come back, but again, had an opportunity off of that level. But again, you can look at other imbalances throughout this chart. There's more than what I'm showing you here. So what there would be an imbalance. Hold on one sec. Let me show you where these imbalances are. There's an imbalance here. There's an imbalance here. This is where the market filled right now. This little imbalance here. So you know you're getting into the trade here. There's a big imbalance here. We already filled that. And then we would expect the market to come back up into this imbalance and then maybe drop and then maybe come back up and fill these levels. Now, sometime it may just go through all these levels, come up to this upper level. We don't know where the market's going to go, but we have levels and zones where we can look for opportunities with price action and volume to help us to understand where the market may go. So those are the ways that you're going to be able to trade this market. All right. Again, you can see that imbalance, how the market bounced off of that level. So this lower imbalance, we still have this imbalance that the market will probably eventually come to. All right, we didn't even fill this whole imbalance yet. Again, so we're still looking at the market possibly coming down, filling this whole imbalance and coming down to this level. But again, you have liquidity at these levels before we get down to there. So you have this sell side liquidity here. All right. This is liquidity where we moved into the imbalance. You have liquidity here, buy side liquidity. So you have these liquidity levels. Mostly these highs with these wicks are going to be areas of liquidity. All right. So think about those levels as levels where the market comes down to. As you could see here, the market had a nice liquidity here, came down, grabbed it, moved higher, then broke through. All right. Came down and touched this level. This was where more liquidity was. Again, for me, this is a basic fractal bounce off of a liquidity level, buy side liquidity level. Then you could see where the market moved higher to. All right, all these things are in the courses that I teach, all about these fractal bounces, trading hard, how to trade these fractal breaks and fractal bounces. Major part of my trading strategy. All right. So really want you to understand that these imbalances are strong, and they're going to be able to help you to look for levels to trade. You should never trade the market unless you have a level to trade the market. All right. If you don't have a level to trade, then don't trade the market. You want to have something that you're trading that is going to help you to support your trade. Again, now, if you want to trade the same things that I'm trading, I like to draw these levels on my own. So I like to use my hand to draw these levels and put them in. But you can also use one of the indicators that were created by TradingView, and you can see how it's drawing these imbalances already. All right, you can see these imbalances, and that's where you would look at. That tool, again, here's another tool. This is a different one, but it's drawing these imbalances. So you can see both of them drawing these imbalances. This one's making them gray. This one's making them pink. But what happens on this one is the ones that are getting filled, they disappear. As you can see, it's getting filled. So here, this one, but as it gets filled, it disappears with this indicator. This indicator doesn't do that. And I prefer not to delete it until I'll delete it myself, but it moves up, and I like to keep that whole zone there because I'm still trading that whole zone So if you want to trade TradingView, there's a couple that you can use. I'm going to show you real quick. One of them is FVG imbalance zones at JP7FX. That would be the FVG imbalance zones. That would be one that you would use. All right, that's a good one. I suggest that you try on your chart and trade those imbalances. It would, I believe, it would use these pink ones. All right, guys. So if you want your trading to trend upward, then learn this strategy. This strategy is going to help you pretty much to understand where to trade and know the levels to trade. Going to help you to understand where the imbalance is, where the level may come back to. You always, again, want to have a level. So again, guys, I'm glad that I'm able to help you. Hopefully it is helping you. One thing I need you to do is give me some likes. If you do like this video, give me a thumbs up and so forth. But again, hopefully this helped you. Again, remember, join that Apex Trader funding. And when you do join that, I'm going to help you to pass your eval, because I'm going to trade live with you and let you know how to pass your eval and give you the tools to pass your eval. All right. So until then, guys, hope you have a great one. Hope you have a happy new year. God bless. So long.